Welcome back to the Group Practice Accelerator podcast, brought to you by Polaris Healthcare Partners, where we leverage decades of healthcare and business experience to drive growth in successful group practices just like yours. If you're a healthcare entrepreneur and you're interested in building, scaling, or exiting your group practice, you've found not only the industry's leading resource for business education, but a team of trusted advisors dedicated to helping you achieve and exceed your goals. In short, the team at Polaris creates clarity, confidence, and results. I'm your host, Jamie Falasz, and the Group Practice Accelerator podcast is on the air. Well, hey, everybody. Thanks for joining me for another episode. We have some really important things that we need to talk about today, and even a little bit of uncomfortable truth. Now, I know most of you are pretty well versed about who Polaris is and what we do, but we consistently have new subscribers and listeners, and we almost had a little bit of an identity crisis around here when a couple of listeners were completely unaware that we manage transactions, specifically sell side. And we do that often, I might add. So today I want to spend some time providing clarity, both for our longtime listeners and our new listeners, because yes, we manage a lot of practice and group sales, but really the clarity that I want to provide is around how we do that and how it relates to the market and our experience behind it and even your experiences, because we don't want any assumptions being made. And as most of you already know, we're not just brokers because of how we approach and manage transactions to begin with, which often comes long before you actually go to market. And I know that makes sense to a lot of our longtime listeners already, because literally everything we do is centered around achieving your maximum value and getting that for your business, whether you want to build a legacy or you want to head off into the sunset. So whether you've been a subscriber for 4 days or 4 years, I'm confident you're going to learn something new today, because we're going to share a little bit of that uncomfortable truth for everyone. And here to help us broaden our understanding and growth and eventual exit conversation is our own founder and CEO, Diwakar Sinha. Diwakar, welcome back to the show.
Jamie, thanks for having me.
Well, good to see you. I want to jump right into this topic today, and we'll get to the awkward stuff first. So, the general consensus and the conversations out there with people in the market has been maybe that valuations are not quite there, or they exited during a recap with a DSO and it didn't quite meet their expectations, I'll say. Can you talk through a little bit of that for people? Because I want to start with those, the uncomfortability of the last couple of years, so we can turn that corner and provide a little bit more insight for people that are maybe thinking about transacting in the next year to 5 years and maybe go down that road.
Sure. Yeah. So I think, I call it the uncomfortable truth, right? So I think it's okay to talk about, where the market was pre-COVID and coming out of COVID and where we are today, and the opportunity that lays in front of us in the next 12 to 24 months.
Yeah.
So I think as the market was consolidating pre-COVID, valuations were probably at an all-time high and going into COVID. And coming out of COVID, I think the markets were great. And really, one would argue, probably at sometimes at a peak as far as some valuations goes. And I think the question you may have is, okay, some people may not have partnered up with the DSO, and are they or are they not realizing the exit that they're, if they're in a 3 or 5 or 7 year hold out there. And I can't speak for some of the transactions that were done out there, but I can speak on a macro space, what may or may not have happened. So, the average buyer in the space holds a transaction 5 to 7 years out. So, what may have happened if you went into a transaction in 2017 or 18, you might have tried to get out around 2021, 22. Well, the strategic at that point, or the DSO at that point, may not have been able to get out due to cost of capital. Okay. The conditions. I mean, if you remember, the SOFR at that point and cost of capital was extremely high. And so that would, if they were transacting as a $50, $100, $150 million EBITDA business, the valuations are probably compressed at 1 to 3 turns at that point. So yes, as a shareholder of a holdco or a JV level, depending on how your agreements were structured, that's going to cause some challenges on an exit on a macro level. So I think, those are issues that are there. So I think that's part of the challenge that some parties experience out there. The other issue to potentially take into account, I will say this as a sell side advisor, coming out of 2021, there are some buyers in the space that bought practices and didn't structure those deals correctly. And I think that just needs to be said. That's an uncomfortable truth in the market
Yeah.
that they, did some deals that just weren't structured. It was more of a pricing buy, and they did not integrate. They did not grow the companies in the market. And yes, some DSOs did not perform or are not performing out there.
Mhm.
But just like anything else out there, I think the 10% is creating the noise for the 90%. Okay.
Agree.
And I do think there's a lot of companies that are performing well. I do believe a lot of companies have slowed down their acquisition process, focused on integration, hang down their debt and balance sheet. Yes, some of those companies out there might have paid a premium in 21, 22, and because it was what the market was coming out in 21, 22. Focus on integration. They did structure the deals correctly and focused on improving shareholder value, right?
Yeah.
And they're coming out of that and going into 25, 26. I've talked to some of those leaderships and says, you know what, we want to be smart when we go to market in 26. And some of the bigger DSOs are going to market in 26 and are really positioned well. And they view their market as 2026 to go to market and transacting latter part of 26 to early 2027. If not, they're cleaning up their businesses now to go start the process end of 25 to Q1 2026. I think the bigger thing to focus on is how do you partner up with the companies that have really done a good job in structuring deals, um, coming out of COVID. How do you find the right partners that are out there that have positioned their balance sheet really well, that have created good leverage? And when I say good leverage, we've talked about how, leverage is max 3 times, maybe 4 times. These bigger DSOs are sub 3 times leverage out there, done a really good job out there. And how do you partner up with them? We've done podcasts around, um, holdco versus JV equity.
Mhm.
Both have value and how to structure those deals out there, finding the right partner. Are you going to get distribution rights? Are you willing to give up distribution rights? Again, different companies have different positives out there. Finding the right partner, looking at how they've aggregated historically. We have access to different information on different DSOs where we can provide our clients that information and be able to help decipher what is the right strategic partner for them as they're making that decision.
Yeah, because, we get some whispers out there, and I just want to make sure we're putting everything on the table here, like you and I talked about and doing some planning for this podcast today. And I really want to be frank about this because when you talk to one person, hey, my buddy didn't really get what they wanted out of this deal. So I want to make sure that we cover everything from the last couple of years. Now that we've fast forwarded, post pandemic, what are some of the other things that people aren't talking about that we need to talk about before we get into the "Hey, are you ready?" portion of this podcast? I want to spend a little more time on, let's talk about the uncomfortable stuff first and just be honest.
Yeah, I mean, again, like I said, in that 10%, right? There are some companies that have had performance issues. They've had some level of divestitures and things like that out there.
Mm.
But again, some deals were structured incorrectly. People have had to focus on those issues. But again, majority of those companies, are focusing on a recap right now.
Yeah.
Are starting to position themselves going into 2026. On the growth strategy. Cost of capital has gone down 50 basis points in the last 4 months. So I think, for the bigger companies, if you have a $50 million or $100 million, outstanding debt on a middle market facility, a 50 basis points reduction on your balance sheet has a meaningful value in how you're able to deploy that capital to aggregate in the market. So I think for our audience members, that's an amazing timing as far as how you position yourself going into Q4, Q1, Q2, depending on the size of the deal. And again, some of the bigger deals might be Q3, Q4. So I think the opportunity is there. Again, 10% of the market has had some challenges. I think it'll work itself out as they kind of go to market and try to clean up their balance sheet. The other 90% is still positioned really well. They continue to focus on same store growth, paying down their debt and balance sheet. They are focusing on acquiring in the market. The rate reduction is helping a lot. I generally think in Q1, January, to maybe in the March Fed, they're going to do another 25 basis points. We talked about this early in the year. So I think there's tremendous opportunity going into it, as far as positioning your market going to Q1.
I was just going to call out whatever crystal ball you have, because we did a podcast back in Q1 where you predicted this exact drop in basis points. So if you
if I play the lottery numbers, I would be, I know the Mega Million numbers, the Powerball numbers. I wish I could do it. I think I generally, when you look at market conditions overall, I think, those were the indicators I was looking at and saying, okay, we should have those changes, right?
Yeah.
And I generally believe we should have another 25 basis points in the next 4 to 6 months. And again, talking about M&A, and we always want to advise our audience members to plan ahead for M&A. You just can't take a business to market, the right business to market overnight. Also start thinking about tax considerations. I generally believe going into 2026, there's going to be meaningful tax considerations that might be coming down the pipe. Again, not a guarantee, but there should be meaningful. So I think, again, 2026 is going to be an amazing year for M&A activity. Again, another 25 basis points. Businesses need to be ready for 2026 to be that year for them. I guess structural matter. We've talked about this in our other previous podcast that, we focus on structure. Valuation matters. Absolutely agree.
Yeah.
But we've been able to focus on the holistic life cycle of a value of a deal, not just the upfront value. And again, Jamie, you started off the podcast by focusing on the back end value and how people have not realized the back end value. And we focus not just on the front end value, but the back end value of a deal. And I think that's really should be the takeaway for a lot of the audience members today.
Yeah. So let's pause before we move into the getting ready for, hey, am I ready for 2026? And, let's get going if you're not. But before we do that, let's address for our newer subscribers and maybe a recap for listeners that have been with us the full 4+ years, what Polaris actually does, meaning what makes our approach different? What tools do we have in our toolbox to get people prepared for a sale, or even if you want to hang on to the business, even if this is a legacy business? And more importantly, why is that valuable? Like, what makes our approach different and valuable?
So, for our audience members, we do have transaction advisory and growth strategy consulting, right? Either way, we want to build a business to sell or carry on a legacy. So some of our audience members may be thinking, say, I want to build this business and I want to create generational wealth. And generational wealth may not mean transacting to a strategic or private equity. They may mean, I want to hand this out to my family members. I'm going to create a living trust, and that's going to be running my business. And there's nothing wrong with that, right? We want to help them build a business that is running independent of them, that continues to grow around it, right? So they might be going from 5 to 15 to 25 to 50 locations. And so that's the kind of business we want to help them do it. We also, but in the same context, that is a business built to sell, because that makes it really attractive from a buyer's lens, because now that business has an identity, has patient care values, has created the right culture with providers, and has a vision that is allowed to grow right out there. So, when we take a business to market, what makes us unique is we do all the diligence in-house. We don't outsource it. And we create a pitch book or a SIM ourselves. And then depending on the size of transaction, it's very important is we do outsource a sell side quality of earnings. So a lot of different firms will do a quality of earnings, but that quality of earnings is in-house. Okay. That's not a quality of earnings. It has to be an outsource. It has to be a third-party CPA. We outsource to a third-party firm, which is a quality of earnings. And we will work to make sure the methodology is correct, the process is correct, and that ensures a defensible position going to market. And depending on the size of a business, and as again, we're moving upstream and upstream and upstream, we'll also look at clinical due diligence on the transaction to make sure that as we're looking at the business, and if they're going across lines and depending on the size of the revenue, that the clinical philosophy and the payer philosophy is not going to change as the business continues to scale. So these are all things that make us unique in the space, that provide buyer confidence for the business and align the buyer to provide the highest LOI and ensure the integrity of the valuation does not change from LOI to closing. And that is what
Very
makes us
important.
unique in this space.
Yeah.
And again, beyond that, as we run a full process, aligning the LOI and then now focusing on the cultural values
Mm.
between the principal and the buyer pool to make sure that that makes sense in the process. And so, as we've said in our previous podcast, a process can take on a smaller deals, they're going to be about 4 months to about 6, 7 months. Those are smaller deals, and then our bigger deals can take anywhere from 6 months to a year. So they're very comprehensive in the process.
Yeah, and it goes without saying that it is so critical to be ready. A lot of people get approached before they're actually ready. And what does that do? It leaves value on the table, of course. And if you're not ready, you're not going to get maximum value. So let's talk about some of the ways that we help our clients achieve maximum value in that time frame before we go to market.
Sure. Yeah. I mean, as somebody approaches us and says, "Hey, I'm looking to go to market," we do a full diligence on it and figure out, okay, what are the areas that a interested party is going to look at the business and focus on areas that we can help them improve while we're in market with them.
Mhm.
If we can work on a 1/4% or 0.5% or 1% improvement and work with them in process to help get that improvement for them, we want to work on that. Okay. And depending on the size of business, if they're at 3, 4, $5 million in EBITDA, even a 0.5% improvement is a meaningful improvement in valuation,
Yeah,
for that business. That might cover the cost of a quality of earnings in some of these transactions. So we are meaningfully focused on some of these savings on it. So from the time we get engaged, we're focused on operational efficiency as we're going to market. From the time we're engaged, we're focused on the alignment of what the business wants to be. We're focused on the executive team. We want to understand what is the executive team's goals? What does the partnership strategy look like for the doctors? We want to make sure that there's continuity of care, continuity of the operations team. That is what makes the business more valuable. I just did an article about how to maximize the value of a business beyond EBITDA. I think
mhm,
people go to conferences and everyone focuses on EBITDA. Yes, EBITDA is a good denominator to look at a value and gets people interested. Absolutely agree. But there's so much more than EBITDA to a business. Okay.
absolutely.
One, it's people, right? It's a people business.
Yeah,
Healthcare is a people business.
it has
So
to
we
be.
want to understand how people are running the business and how will the business run post transaction. So we start focusing on those underlying things the moment we get engaged and start focusing on that as part of our process in our diligence to make sure that that business is represented well, presented well, because that's really as we get engaged. We can see from the principal's lens and the executive team's lens that that's really important because that's what they worked for, especially the ones that are running really well. They take pride in that. They take ownership in the fact that they've built that business. And we want them to see that in our in how we represent the pitch book and how we represent them in the market.
Tell our listeners a little bit more about the pitch book. You and I have talked about this at length, but I just want to give them a little bit of a preview on why that's an important element.
So a pitch book is also known as a SIM, which is confidential information memorandum. A pitch book is our story. It's how we tell the story about the business, about the leadership, about how the company was built, where the company is, and where the company's headed. We will break down bios of the leadership team, the principals, potential partners, associates, everything about the business. This is our way to present the opportunity at hand and where the business is headed. That could be anywhere from 10, 15 pages to 40 to 50 pages, depending on the size of the business. So we spend a lot of time understanding, interviewing the executive team, the principals, and understand the organizational chart, the financials, and we'll highlight the opportunity and if there's some issue that happened in 2024, 2023, we'll talk about it. I openly talk about there's a miss in the business. Let's bring it to bear early on in the pitch book. But also let's talk about where the business is headed in 2026 and 2027 in the pitch book. And I think that's how I view it as the opportunity because I think the interested parties will look at the financials. They'll go through our data room. Our data room is very robust. At the same time, they'll look at our pitch book and we get to tell a story at that point. So I think that's something we take a lot of pride in.
Well, and that's something that I find very concerning. When you don't get to tell your story and you're approached out of the blue, how can you possibly get the maximum value from your business? How can you possibly get every dollar that you have earned and put into your business when they don't really know that much about you? I mean, there's going to be some element of it, but to me, that pitch book and framing who you are in your best light, or even maybe a couple little ugly pieces that need some explanation, to me that's the way to do it properly. That's the way to create the maximum value from that exit that you were looking to do all along. So critical piece. Thank you for going through that with us.
Yeah, and again, one of the things for a lot of our audience members to think about, the exit is really for most of them 5 to 10 years out from
Hmm.
the time they approach us. All right. So if somebody comes to us and says, I want to be in Bahamas tomorrow, let me put it this way. I want to be in Bahamas tomorrow for the audience members. We can't facilitate that. That's not us. There's firms out there that maybe can, but that's not us. They're going to take a meaningful haircut on their valuations.
Right.
But if somebody is looking to find a partner that can be with them for the next 5 to 10 years, okay, then we have a robust database that can help them achieve that outcome. Because we're focused on not just the value up front, but the structure value, which is how this podcast started. Okay. Defining the right partner. And those are the things we're focused on to help achieve that outcome. So I think that's what people need to be thinking about, that, hey, we are here in 2025. Where's my exit in 2030 to 2035 look like? And so that's why I should be thinking about with Polaris on this podcast.
Yeah, it's a process. Like I said, there are plenty of firms out there that'll help you sell your practice tomorrow, but I'll take your words. They're going to take a haircut. So why not put the time, put the effort into it now and really get out of it what you've put into it, because you will. That's for sure. Well, Diwakar, it's always good to have you on the show. I'm really grateful that you're able to provide this insight for our newer listeners and subscribers, and for some of our longtime listeners and subscribers. We all forget little pieces of this, but it's a good way to kind of come back to the foundation of what we're here to help you do. So we appreciate your experience.
Jamie, thank you for having me. And thank you to all the audience members for staying with us throughout the years. Much appreciated.
Absolutely. We appreciate your support, and go ahead and subscribe. If you're not a subscriber, you'll get notifications every week of the podcast. Also, Diwakar touched on something earlier about one of his articles. There's now a weekly article that comes out with his experiences, Prateet, and these insights that you don't want to miss. Those will come out via email, so make sure you're a subscriber. You can also catch them on LinkedIn. But as always, if you want to learn about any of our expert advisory services, or maybe there's a topic that we haven't covered on the podcast that you'd like to hear about, you can send us an email to info@polarishealthcarepartners.com, or you can reach us by visiting our website. Go up to that Contact Us button at polarishealthcarepartners.com. Thanks so much for being a loyal listener and subscriber. If you enjoyed today's episode, please share it with a colleague, and be sure to leave us a rating on your favorite podcast platforms. We'll see you on the next episode of the Group Practice Accelerator Podcast.